Hey, I'm Jason, and this is Supply and Demand Daily, where I tell you what we learned about the economy today. I have a lot of data for you. Well, relatively not a ton of data, but I have data on manufacturing and services sector businesses and their activity. So we have a couple of indexes or indices, is actually, I think, the grammatically correct way of saying that. But anyway, and then we got some huge landmark slam dunk data on new home sales today, which was the biggest decline. And I think what I saw on Twitter, which is the best source of information. You always find the most accurate and completely well researched information on Twitter. But anyway, some analyst somewhere said that that was the largest decline in 9 years. And I went in the data and looked at it, and that appears to be true. So I just wasn't the first person to say it, unfortunately, but I have a day job, so can you blame me? Anyway, and then the last thing that we're going to talk about is the index of stripper sentiment, which is not really a thing, but I hope somebody makes it a thing. I might make it a thing because I saw some interesting reporting on the ground from the strip club world on Twitter today, and it does portend or foretell, whatever word you want to put in there, something about the condition of the United States economy. So I'm going to get out of the way and we'll get right into it. All right. Sound good? Okay, so manufacturing and services are both down. We're going to start there. So here I have the S&P Global PMI, which stands for Purchasing Managers Index, and this is the composite Purchasing Managers Index. So if you look at the blue line here, this is a number that is designed to tell you the sentiment and the business activity level in both the manufacturing and services sectors. And the reason that it's called the Purchasing Managers Index is because that's typically who the survey goes to. And I'll talk about the kind of questions here in just a couple minutes that are on this survey. But first, I want to talk to you about what's being pointed out here. The relationship that they are showing with this chart, I had to take a screenshot because you have to pay big money for this data. But they released the reports on PDFs for free. So what's being pointed out in this chart is that there's a pretty tight correlation between GDP growth, that is the growth in gross domestic product, which is economists' preferred way of showing or displaying all of the production that gets done in the economy in a given period of time, whether that's quarterly or annual. And then you have this blue line, which is that sentiment and that activity indicator that I just mentioned a few seconds ago. And as you can see, there's a pretty tight relationship. It's not perfect and it's not amazing, but it's pretty tight. So anyway, we have this gray bar here for the first quarter of 2022, and that is the gray bar that signifies that real gross domestic product actually dropped in the quarter that ended March 31st, 2022. And I just wanted to point out in the month of April, the level on this index was 56, and it dropped a little bit by 2.2 points down to 53.8. So we're looking at a little bit of a decline. As you can see, we are still in relatively normal territory as compared to prior years. But leading up to the manufacturing recession of 2015, there were some dips that were about in line with the level that we're at today, kind of the 53, the 54 mark. So something to pay attention to there, and we'll certainly see what it does next month. The next thing that I'm going to point out is we're going to separate this composite index into manufacturing only. So this is the Global Flash Manufacturing Purchasing Managers Index, and it's designed to tell you about the general business conditions for these manufacturing businesses, and the story is actually a little bit more optimistic here. Even though it's been falling considerably from these highs that were in 2021, and it has been falling for several months now, which is certainly pessimistic, but if you just notice the level, we're sitting at 57.5, which is down 1 point, whatever that is, 1.8, 1.7 from the month before in April. But this level in general is pretty well elevated, and it compares nicely with levels going back to before the manufacturing recession and after it in 2015 or 2014, in 2018. So that's not necessarily a terrible reading, but it has been heading in a negative direction in general. You've had one upswing here in early 2022, but it has been heading in a negative general direction for several months. Next, the thing that I think everybody's going to be a little bit more interested in is the activity in the oh yeah, I got to do better at memorizing what's on these slides. So the composite index, what's in there? So it's half made up of services and half made up of manufacturers. For the services index, you can't really judge quantities because the service, isn't provided. I guess you could do hours of time spent, but that's not really telling you much about how much service is being produced. So for the services survey, what they ask is your business activity higher, lower, or about the same than it was a month ago? And then the manufacturing, if you've watched my videos on the Empire State Index and the Philadelphia Fed Index, this manufacturing index is very much the same. You take the percentage of purchasing managers in this manufacturing industry who are reporting that their new orders have gone up versus have gone down, their output has gone up versus gone down, their employment, the amount of hiring they're doing has gone up versus gone down, and then you aggregate all these things together. It's a weighted average. So what it means to say that the manufacturing PMI is 57.5 is that there are more purchasing managers reporting that their business activity has gone up than there are reporting that it has gone down, and the difference is about 7.5% to the upside. So if you wanted to put that number into a sentence, that's how you would do it. And I think it's important to explain that because, it's not really straightforward exactly what we're tracking with these sorts of indexes. So anyway, indices is the proper English for that. So anyway, now we're going to get into new home sales, and holy crap, they fell 22% on a seasonally adjusted basis in April. And as you can see from this chart here, this is 5 years of data going back to 2017, which is by no means a long run series, but it kind of gives you a baseline to judge what activity was like in 2020 and 2021 versus what it's like now. And we have seen a pretty serious decline. We're now back in line with the prevailing average that was happening going into the pandemic from, 2017 to around 2019 and early 2020. This is the level that was achieved in April of 2020, the first month of major lockdowns and of, COVID stay-at-home orders and all that stuff, when basically all in-person activity had dropped to virtually nothing. So this is a pretty serious reading, and what I'll be looking for next month is to see if this declines even further, because activity is directly related to home prices. You have to have activity in the industry to keep prices going up or even to keep them stable. And so if you see a significant fall of if this particular level of activity goes down below where it was before the pandemic, then that really tells us that we're in for some serious corrections in prices. One thing that I should point out is that the housing market doesn't correct on a very quick basis the same way that stocks and bonds do, because there's just a lot more you have to spend a lot more time in the process of buying and bidding for a house and so on and so forth. So it does take a little bit longer to see these changes. And so when we talk about maybe a crash in real estate prices, this is something that's going to happen over the course of, maybe 1 to 2 years to get all the way down to wherever the bottom ends up being in single family home prices. So just something to keep in mind, even though we'll probably see the trend in prices themselves reverse before the end of this year. And I hope to share some detail on that here in the near future. But I want to move on now to what's going on with the home building sector. So the home building sector has definitely been directly correlated with activity in the housing market. This is probably the biggest ETF that represents home builders. It's the S&P Home Builders Sector ETF. And as you can see, it peaked here in the beginning of 2022. Obviously this year, at a price of about $86.39, $86.39. And now it's sitting here all the way down to $57.37. So it's dropped $37 off of its all-time high. And then I want to just go ahead and compare that on a percentage basis to another, to a related index, which would be the Dow Jones Industrial Average. So the white line is the home building business sector ETF, and then the orange line is the Dow Jones Industrial Average, or an ETF that's based on the Dow Jones Industrial Average. That's down 8.1%, and the home building sector is down 21.5%, or closer to 21.6. So that's a pretty serious thing, and that tends to happen when there's a slowdown in housing market activity. You do start to see the home building sector go in for a correction once that happens, and that has certainly been the case here. Now, economics and strip clubs. This is an underappreciated economic indicator. I think there's certainly not an index that's published by any universities that is, related or reports on strip club activities. But think about it this way. It tells you something about consumer discretionary spending. If I am your typical average consumer, well, if I'm going to strip clubs, then I probably have a little bit more money than the average consumer. I don't know. I've never been to one. But anyway, if I'm in that situation and my economic prospects start to drop off a little bit, then there are certain things that I can do to ease that situation a little bit. One thing I can do is I can downgrade the car that I drive. So maybe I drive a BMW. But the problem with that is, maybe I drive an Audi. The problem with that is everybody's going to judge me when I do it, and they're going to know something about my financial situation, because why would I elect to get out of a nice car and change over to something average like a Toyota Camry or something? Why would I do that? Well, I mean, I would do it because it would be good for my financial situation. It would maybe save me a little bit of money. Of course, I don't know about that in this environment of car prices and interest rates, but let's say that it could save me a little bit of money to get out of an expensive car. The problem is that the social stigma associated with doing that is very high. So I pay a little bit of an emotional cost to get out of that trade. Whereas if I'm going to the strip club, 2-3 times a week, or maybe even once a week, Nobody really knows that I do that anyway. So I can drop that spending without anybody knowing that my lifestyle has changed. And so maybe strip clubs are the canary in the economic or the consumer spending coal mine. This is interesting. I really should have gotten on Twitter before this year because, maybe I would have learned a little bit more about the world. I sit and look at a computer screen and look at economic indicators, and, the people in this industry have known that there's a recession coming for months, which so have I, based on charts and data. But anyway, so I picked out a couple of tweets from stripper Twitter here that I wanted to point out, and I did hide the profile pictures for the purposes of they're a little bit more on the revealing side. So that's not what this podcast is about, I'm sure, or not YouTube channel, whatever. Anyway, so yeah, I just wanted to share those with you. So Reverse Cowgirl 69, which I have no idea what either of those references mean in the slightest, who goes by @Botticelli_Bimbo, May 19th, the strip club is sadly a leading indicator, and I can promise y'all we are in a recession, Lamau. Okay, so yeah, I'm pretty confident there. Maybe we're seeing a little bit less activity in the strip clubs. Cool. And then Lana Agave, who has 2 cherries next to her name. I'm not sure what the significance of that is. It's just $4 OF sale. $4 of sale. I'm not sure. Anyway, so she goes by agave_baby, and this is on May 20th. And this is a reply to the response from Reverse Cowgirl 69. I'm not sure when. These are very creative names, but I think something is being referenced here. I'm just not sure what. But anyway, she says, nah, for real, or nah, FR. I think that means for real. Reading all these articles, journalists and economists are like, we're not in a recession. We might not even get one this year or next, ... like the club is dead, babe, YWM, which I believe, if my acronyms are correct, that means, what do you mean? But I just love this. I love this because, when we get into these economic downturns, For example, economists said for years that the recovery after the Great Recession was great, and by the time 2016 rolled around, the economy was booming. We had a low unemployment rate. By the time Trump was, I guess, a couple years into his presidency, the unemployment rate was super low at like 3 point something percent, historically low unemployment and all this. But then you ask people on the ground who, really interact with the nuts and bolts of the economy every day. And honestly, like if you took a survey just walking down any street in America, except for maybe New York or Los Angeles or one of the financial centers, DC maybe, nobody would tell you that the economy was rip-roaring in the 10 years after the Great Recession. Like there was definitely a sentiment in the air, no matter who you talk to, that like, no, I mean, pay raises are not happening, wages are not growing very fast, and maybe the unemployment rate is this, but I know a bunch of people who have been ready and willing to work for years and have even applied for jobs, here and there around the same time, and haven't been able to secure any kind of employment. So this is another example. I would say in a situation like this, I think there are a lot of strippers who probably have more wisdom to offer about the economy than honestly myself or any professional economist or a lot of professional economists in the industry. But it also just points to the fact that it's important to just keep your eyes peeled if you really want to understand what's going on with the economy and economic activity. It's important just to keep your eyes peeled and observe what's going on around you. There's consumer sentiment is a thing, and you can definitely match these different things with with drops in general activity. You can tell by how much traffic is on the road, how many people are going to coffee shops rather than making it at home, how many people are spending time in malls and going to movies and all those kinds of things. The economy is all around you, and even though I like to report on charts and data, all of the wisdom and all of the knowledge is not in these corporate in these data institute or government institution compiled statistics. There's a lot that you can learn just by kind of observing what's going on around you, especially in strip clubs, apparently. And again, the point is that strip clubs are a highly consumer discretionary. That means you don't have to spend money on going to the strip club. It's not something you're forced to do. It's not like food or gasoline or, the roof over your head or anything like that. These are things that people elect to do. And so when those things start to drop, activities in these areas start to drop a lot, that's an indicator that people are either short on income or they're worried about what their income might be like in the near future. So that maybe they're feeling concerned that they need to hold on to their cash and beef up their nest a little bit and have some spare capacity here and there. So that's all I wanted to share with you today. I hope you've enjoyed this Supply and Demand Daily. I'll be back tomorrow with, the median home prices come out tomorrow, the median prices of new homes sold in America, and a couple of other things like that. So I hope you'll join me on Wednesday, May 25th, 2022, and I hope you enjoy the rest of your evening. Thank you very much, and have a great day. Goodbye.